Today, I am thrilled to be talking about an incredibly important topic that I think we really can all use a refresher on. And Lisa and I were just talking before we brought everybody in about how often she gets asked about this topic, no matter where the individual is in their life cycle. And that topic is financial literacy. I've spoken to so many people who wish they had learned more about personal financial literacy during high school, or wish their kids who are that age group could have learned more about it in their curriculum in school. And that's what we're going to hope to accomplish today. So today I'm joined by Lisa Crosta, a CFP, CPA, and MBA. She is a senior wealth advisor and director of financial planning at Crescent Harbor Private Wealth. Welcome, Lisa, and thank you for joining us today.
Thank you for having me. Happy to be here.
So by way of background, I listened to a podcast that Lisa did a few months back now, and it was predominantly about financial literacy for women. And I knew that we needed to have her on office hours. So let's jump right in. And we're going to run through several ideas and areas related to financial literacy. And Lisa has some really great takeaways within each section for everybody. But first, let's start with a poll, just to get the pulse of the audience. So our first poll is, do you wish you knew about financial literacy earlier in your life? Yes or no? Wow, that was a unanimous one. See, we picked a great topic to kick off 2025 with. I also think it's a good topic because, listen, it's January. Everybody's kind of going through the New Year's resolutions. What can I do differently? How can I end the year better than I started? So this is a great little top of mind discussion. So Lisa, let's start with the topic of spending and cash flow and debt. And I hear so often from clients, business owners, that running a business is not the same as running your household. And maybe that's because one spouse handles the business, the other spouse handles the family finances. Your advice is to be in the know. Is that a fair way of assessing that?
Absolutely. Absolutely. You know, burying your head in the sand is never a good strategy. You have to figure out what's going on. You have to know what's coming in and what's going out. I mean, to put it in very simple terms, but yes, 100% agree.
Even if you're not the one who's doing the main heavy lift of saying money management or bill pay or budgeting or things like that, right?
Yeah.
You got to communicate and keep people in the loop.
You do. And, you know, I did a workshop a couple summers ago, all towards women, and mostly because this is a terrible stat, but 84% of women are alone at the end of their life, because men tend to die first, and we have reasonably high divorce rates, and people don't always get married. But if you are not paying any attention to anything and you have a death or a divorce and you haven't paid attention, you are lost, and it's a terrible place to be. Nobody wants to plan for that, but nobody wants to be there, but you have to know what's going on. It's a terrible thing to be thrown into. I mean, if for no reason alone, for no other reason, just at one point, you have to know what's going on and have your own understanding of it. It's just the best way.
I remember when we were preparing for this and you gave me that statistic, and I went back and I told my mom, and I was like, she said, that's so depressing. That's terrible. You know, my parents are in their 70s. I was like, but yeah, you've got to know that, Mom, and you've got to tell your friends, and like, they just have to be aware of what's happening, even if they're not the main ones doing it. And I think that's a scary but important statistic to know.
Well, I just have one quick story. I have a college roommate whose father died, heart attack, earlier than expected. Always had a good career. The wife knew nothing. She didn't understand that she was going to lose one of her Social Security checks when he died. She thought she got to keep both of them. And so did my friend. They were like shocked. So you have to understand how things are going to change when there's just one person there.
Yeah, for sure. For sure.
Yeah.
So one of the biggest issues I see when it comes to business owners not knowing where their money goes, whether it's a draw out of the business or, money that isn't left over when your paycheck is deposited and bills are paid every month and there's nothing there.
Yeah.
So the only way we can really successfully tackle this is if we know where we're spending our money. And that really does mean creating a household budget. Can you talk a little bit about that for the audience?
Yeah, well, I like to call this spending plan. I feel like people are more apt to do it if it's a spending plan rather than a budget. So flip it on its head a little bit. I mean, I have a couple tips for this. When I start engaged with a client, we really start to like to start with the cash flow. But some people get so hung up on doing the expenses that they never move forward. So, a couple tips ways to do it. And I do believe everybody should have a plan and understanding of what's coming in and what's going out each month. But if you're not, I have a few engineering clients who will do the giant spreadsheets and spend hours. But, if you're doing that, I'm not speaking to you. If you're trying to figure this out, one way to start easily is start with the fixed expenses, the rent or mortgage, the taxes, utilities, You can get a good number for groceries each week. You know, those basic things, at least get those all down on paper. Make that one number, you know, sum that up, then turn to the things that are variable but happen every month, like Amazon charges, haircuts, nails, you know, gym membership. You should know what that is. It's pretty easy to figure out. So, you know, dinners out, throw some number in there. Like, okay, we go out once a week. There's 4 weeks in the month. So it's an average of $150, you know, put the number down. And then the third category is the annual stuff. That's always hard to put on a monthly number, like trips, holiday gifts. And so if you bucket it, you can start figuring it out better, and you can also start plugging it. You know, you don't have to get exact. But I still have clients that that's too much for. So what we do is we flip it the other way around. Say, do you know what comes in? Usually you know what's coming in. There's a draw, there may be rental income, W-2, you know, whatever comes in. Social Security if you're in retirement. And for 3 months, track at the end of the month where you are, you know, before the next thing comes in. Where are you? Are you pulling from a savings account every month where you have about $1,000 left over maybe, or do you have 10 grand left over? I don't know. But that's a real quick back of the envelope way to do it, because most people have a better idea of what comes in, and then just figure it out at the end of the month, wherever you are. If you're plus $1,000, that means you know that you spend 1,000 less than you bring in, and then work from that number. At least it gets you moving to the next step of planning. So,
And I think one of the big challenges, and you touched on it a little bit, is really understanding that what happens on the credit card, right? Because, you know, our mortgage is a set bill, our you know,
yes.
utilities for the most part, you know, you can put numbers, like you said, around gym memberships and your car payment and insurance and all of that. But, you know, then there's this sort of, I'll call it a void
Yeah.
of, you know, a credit card payment that hopefully you're paying every month and
Yeah.
paying it down to zero and not, you know, accruing interest and all of that on a credit card balance. But what's happening on there? Is it endless Amazon charges? Is it, you know, subscriptions and memberships and things that you don't use anymore and
Yeah.
that can go away or be reduced? And, you know, really when you get down to that level of detail, if you're ready for that, that's really
Mhm.
where it becomes a little bit eye-opening and more able to control your spending plan, because you really see where every dollar is essentially going.
And people get tripped up because they're doing their expenses like, well, I know I spend 120 on the gym, and then so putting it in this bucket, but then it's also on the credit card. So it does get a little messy. You know, sometimes clients just have a flat number of $2,500 credit card or whatever, this much Amex, but it is, you sound, you know, we've all heard this. You should look at it. I mean, we all have subscriptions we've forgotten about. We all have charges that were fraudulent. You should take a gander on that statement each month. And if you're overspending, you have to dig in more than you want to. You know, if you're flush and you're saving 20%, you got extra here. Okay, don't analyze the Amazon charges. But if you need to rein some stuff in, you're going to have to look at it, unfortunately.
Yep. And
Like
it's
anything in life.
uncomfortable, but you
Yeah,
know, it's important.
right, right.
So highly technical era that we're in, people like to have things on their phones. I'm old
Yeah,
school. I use a spreadsheet, but
yeah,
are there apps that you can recommend that make spending plans, as you like to call
yeah.
them, and tracking your expenses easier?
Yeah. So I do like the acronym always throws me off. It's you need a budget, but it's it's YNAB.
Okay.
So you need a budget. I really like that one. It allows you also to track, like to put your savings in. You can put how much you're putting to a 401k or a regular savings account, and you can move the money around. Rocket Money's good too. Rocket Money has those commercials. If you've seen, they help you cancel subscriptions as well and track them. That's kind of their thing. But they both are solid. They have different pros and cons. They have, you know, different free versions where and whether you want to upgrade to the higher version. You just have to look at what works for you. But those are the two that I like the most. I will tell you that Mint I used to use was bought by Credit Karma, so it's not the same as it was before. If you're starting from scratch, those are the two I would look at.
Excellent. Good. I still like spreadsheets, but that's all right.
Yeah.
A question I get from a lot of clients who, you know, often ask me to speak to their almost adult children about finances and planning and adulthood are, you know, we're starting our first job, we're looking to get our first apartment. How much of my salary should I be allocating towards living expenses? Are there guidelines or guardrails of certain percentages for sort of the needs, the wants, and the desires, if you will?
Yeah. Yeah. So, I mean, there's the classic one, which still holds the 50-30-20. So, you know, 50% towards your needs. So your mortgage or your rent, probably if you're young, you know, your utilities, your insurance, if there's a common charge on your apartment, wherever you are, The 30% on the wants, so that's going to dinner, going on trips, and then, 20% on savings in a perfect world. And that's tough with your first job, especially if you're working in New York City. But that's sort of the perfect little 50-30-20. But I guess the real life example I would use is how much can my kid spend on rent? And this is how I like to do it. And it's a little, so say you get paid twice a month. A lot of people get paid twice a month, but you can do this in any scenario. If your entire first paycheck goes towards rent, that rent's too high. You can't do it. You can't do everything you can't live on one paycheck. So a third of your money on your rent. And I would say that, and don't count anything else except maybe if you have an HOA type fee, if an apartment that has or if you're in New York, it has a condo charge, a co-op charge, excuse me. But those fixed things that come out in the first of the month, if your whole first paycheck goes towards that, it's too high. I find 33% is a comfortable number to live with.
So just for education purposes,
Yeah.
when you talk about this is my salary and I get paid twice a month, we're applying those percentages to gross salary or to net salary
Net.
after tax?
To net. Has to be net. Yeah.
And I think when I share that with people, they cringe a little bit because that just keeps cutting the pie into smaller pieces.
But I find the paycheck thing when I have most of my clients, are my age group and older, but I do have a few young clients that are doing very well and want a lot of planning. And we talk about this and that idea, that first apartment, if you think of that first paycheck, just go like what you take home. If it all goes to rent, it's too high. You can't afford that. And that's a very tangible thing for them to understand.
Right. When would you suggest is a good time for a younger person to start getting a credit card and building their credit score and that type of thing?
Yeah, I would definitely say college. I mean, 100%. It's, the world's changed a little bit. When I was in college, freshman year, you could walk into the bookstore and they just gave everybody a credit card. They don't do that anymore. So you have to work a little bit to get them. All three of my kids, we got them freshman or sophomore year in college. And to be honest, it was a little bit it wasn't as easy. And they all got cards with about $300 limits on them, 200, like very low. And I would really recommend that. So one, you're building their credit, but even more importantly, you're teaching them how to manage a credit card, because although it'd be in a perfect utopia, we all paid in cash and there was no debt in the world. That's not the world we live in. You have to learn how to manage a credit card and knowing that if you charge it in 28 days, you're going to have to pay for it. And the practice of doing that. And I even hear my kids, I'll hear them say, oh, I got to pay my credit card next week. Like it's in their psyche now that money has to be paid. It has to be set aside. And they know, and they learn that if they don't pay it, every single charge gets charged interest. So you really have to do it to learn it. So I definitely think college, some people use, maybe used to, or, is debit cards an alternative because there's not a lot of cash out there. But with all the fraud out there, we don't want them to be using debit cards at the 7-Eleven and all over the place, because those, you can't get that stuff back if it's fraud. So they're going to need a credit card. So definitely college. And just one little note, if you add your child as an authorized user, some credit card companies, but not all, will report that to credit agencies. So it's unlikely that will help build their credit. They need their own card.
Right. That's a good point. Point. Another question is on paying off debt, and this might go a little bit back to the percentages that you talked about before.
Yeah.
What are your thoughts, Lisa, on paying down debt? Should it be the lowest balance first? Should it be the highest interest rate first? Because there's a couple of different schools of thought out there.
Yeah. I kind of do a combination. I think it should be the highest interest rate first. But if you have, say you have 3 cards, 20,000 on one, 20,000 on another, and 5 on one. And if that $5,000 one doesn't have the highest interest, but psychologically you can get that paid off in 3 months, do it. It's not gonna be that much interest. If you can quickly get that done, get that card put away, psychologically it feels like you check something off the list, and then you start tackling the other two. So the initial is highest interest rate, but if there's some low ones floating around that have small balances, get rid of them. Get rid of the card. Don't cancel the card, but put it in the drawer.
Right.
Yeah, if you cancel the card, it dings your credit a little bit.
Put it in the drawer and lock the drawer.
Yes. Give someone else the key.
Yeah. So you mentioned before your 3 kids, and so you've done your fair share of FAFSA forms lately with all of your kids in college. What are your general thoughts and guidance on student loan debt?
Yeah. So everyone should do the FAFSA. Even if you're not going to get, you don't think you're going to get any financing, your child could get a scholarship from the FAFSA. They could get something that the school is offering but they'll never even be in the running for it if you don't do the FASBA. The FASBA is not difficult. It's been built up. I think it's this drama-filled thing to do. It takes like 15 minutes. And nowadays they pull it directly from your tax return if you let it. It works really well, except for last year when there was a bunch of glitches, but it generally works very well. And it doesn't take long. So I recommend doing it. And the other reason I recommend doing it is everyone is eligible for the direct or the Stafford loans, regardless of income. So, and they total over 4 years, $27,000, and it's spread out amongst the 4 years. Now, if you don't qualify, if your income's too high, you will get unsubsidized loans, meaning the interest accrues while your child's in school. You can qualify for subsidized loans where the interest doesn't accrue. And people are surprised. Sometimes they get that. The formulas they use are very interesting. It's very income-based. Your assets are not nearly as important when you're doing a FASBA, but it's worth doing. You can choose to or not take the money if you don't want, if it's up to you. Doing the form doesn't obligate you to do anything. And then I also have clients that really want their kids to have a little bit of skin in the game. So maybe they say, I'm going to pay for college except for that $27,000. And at the end, if you do great, I'll pay it off. Or maybe I won't. Or if the interest rates, you can make that decision. But the point with those is you can never get that money back. So if you don't do the FASBA in the first year and you give up, it's $5,500 as a freshman. Sophomore year, you can't go, oh, wait, give me that $5,500 that I could have gotten last year. No, it's spread amongst the 4 years. It's very good interest rates. And you never know how the 4 years are going to play out. So I would recommend at least doing them and considering using those loans. You can always pay them back. And the interest rates are great. The second tier of loans, if you need to get them, are the Parent Plus loans, which are high. Those interest rates are high. They are higher than the private interest rates out there. The SoFis and the Sallie Mae's, that the names we hear out there. I was actually shocked at how big the difference in interest rates were. The Parent Plus loans have a little benefit in that they could potentially be put on an income-driven repayment schedule and possibly down the line some sort of forgiveness. The private loans don't have access to any of that. So you do want to think about that a little bit. But for me, the difference in interest rates, it was a no-brainer which ones I was going to use. We're talking 4 or 5 percentage point difference. It's a lot.
That's great advice. That's great advice. And I know there's a lot more to unpack overall about student loans and college and all of that, but that was a good overview. So thank you for that. So let's stick with the theme of, we're helping our soon to be adult children figure out how to adult, and maybe we're helping some adults adult better. And so the concept of living below your means, living at your means or living above your means, right? Can you talk a little bit about that concept in connection with, you're out of school, you're in a job, and now you get your first raise?
Yeah. I like to tell people when you get your first raise, you got to feel some of it. You have to have some of it come to you, but automatically, if you're doing a 401k or 403b at work, bump it up by 1 or 2%. You will barely feel it. So you'll increase your savings and then you'll increase your paycheck a little bit too. Like it can't all go to savings. You have to have a little fun from that money, right? If you got that raise. So I would increase your 401k or 403b. And again, as you know, if it's a pre-tax, you increase it and an extra $1,000 go in, you may only feel $750 of it. So you don't feel it too much and then spread out over the whole year. So try to increase it with each raise for sure.
Yeah. And we'll jump a little bit more into that. We get into the next section on investment and savings. But before we close out the spending, cash flow, debt section, I just want to take another poll just to see from our audience in attendance. Do any of you maintain and monitor, I use the term household budget, but I think I'm going to change my language and start using spending plan, right? Because it's all about mindset. So it's easier to say that I want to stick to a plan versus I want to stick to a budget.
Mm-hmm.
So pretty split down the middle. All right. So a good takeaway from that section then is maybe use one of the apps that Lisa recommended. Maybe use the spreadsheet like I tend to stick to, and start drafting a spending plan or fine tuning one if you may already have one.
Yeah.
Love that. So let's jump into the investment savings, section of this presentation, and overall, what's your recommendation on how much we should be saving? Obviously, this is going to be percentage wise.
Yeah. I mean, if you go back to the 50, 30, 20, it's 20% is the goal. I don't expect kids first out of college to be saving 20%, unless they got, a fantastic job down there in Wall Street and they're making, and their rent is somehow free. But, 20% is a goal. So I feel like if you're not doing it, figure out a way to get there. Like, don't beat yourself up, right? Figure out a way to incrementally get there. But that's a good goal. And if you're really making more than you need from a cash flow standpoint, make sure you're maxing out those retirement plans that are available to you. So that is the next thing we're going to talk about. So I'll talk about some of those numbers.
Yeah, I think that's important because there are a lot of different retirement vehicles, and you get a job or you have a job and you just start contributing hopefully to the 401k or whatever it is that your company offers. But there are a lot of different plans out there. So if you'll take a moment to speak about each of those, that would be great.
Yeah, so these have grown, right? It used to be really simple, but we have 401ks, 403bs, 457s. They're all have a usual, not every company, but they can have a pre-tax and a post-tax option. So we'll start with pre-tax, the traditional fours, we'll call them. You can put in 23,500 a year right now into those. If you're 50 or older, you can put in an extra 7,500. And then there's a weird little super catch-up they put into place.
Thank you, Secure Act.
Yes. If you're 60, 61, 62, or 63, I believe you can put in 11,250 extra, not 7,500 plus, but just 11,250 extra. Now, to put this in, how does it work? Say you make 100 grand, you put 10,000 in. When you get that W-2, the taxable income to you is 90,000. So you only pay tax on that 90,000 because the 10 went in pre-tax. So you're saving pre-tax. Those accounts grow throughout your years, tax deferred. You don't have to pay taxes on them as they go on. You can make changes in them. You can buy and sell things. When you hit retirement years, whatever years those are, and you decide to start taking them out, or you're forced to at age 73, 75, depending on your age, then those dollars are fully taxable as ordinary income. Now, the flip of these, I guess, are the Roths. So there's Roth 401ks, Roth 403bs, Roth 457s. Those go in without any tax savings. So and it's the same limits. It's the 23.5, the extra 7,500. It's the same exact amount you can put in, but you don't save anything now. So if we go back to my same example, you make 100 grand, you put 10,000 into these accounts, you get your W-2, you pay taxes on $100,000. There's no tax savings now, but they go tax deferred, just like the other ones do all throughout your life. No taxes to worry about. When you go to retire and start taking income from those, it's completely tax-free, which is pretty huge if you've been saving for 20 and 30 years for that to grow and not have to pay any taxes on it. We talk about in retirement how you can give yourself some tax flexibility by having these different income streams. Some are taxable, some are not. Some are taxed at capital gains, but it gives you some flexibility to plan in retirement. So it's really nice to have some of these dollars. Now, you also have IRAs, which can be regular and Roth. Much less money can go into those 7,500. I think it is this year. 7,500 is that where we're at? Oh no, 7,000. Excuse me. I mix it up with the catch up. 7,000 into an IRA or 8,000 if you're over 50. But these may or may not be deductible depending on a lot of things that Sarah's obviously aware of, whether you have a plan at work, how much you make. There's also Roth IRAs, which do the same thing. Come out eventually completely tax-free. It's interesting. There's income limits on who can do a Roth IRA. So not everyone can do it if you make too much money, but there's no income limits on a Roth 401k or 403b. So even if you make 300 grand, you can do a Roth 401k or 403b. So I don't know if they intended that, but it's an interesting difference. So all of these accounts are growing over the years, and you just got to keep an eye on how they're going to work in retirement. And that's what we do when we do a lot of plans, like how is this going to work? And all of these plans have rules for retirement, when money must come out for your required minimum distributions. It depends on how old you are, but right now it's about 73, and then it's going to move up to 75 if you're a little bit younger, when you must start taking money out of these. And remember, all the Roth ones come out without tax consequences. And then I won't get into all of it, but they all pass to heirs differently too. And the rules of those keep getting more complex.
Yes. Also, thank you to the Secure Act.
Yes. Secure Act gave you guys full-time employment, right?
I won't dwell on that. One thing I'd love you to touch on briefly, if you can, just conceptually, because we do hear a lot of this from our clients. It's the concept of Roth conversions.
Yeah. So you can take your pre-tax dollars in these accounts and convert them to a Roth. When you do that, the full balance is taxable in the year that you do it. And Then it's now in a Roth, and now it can grow tax-free and come out tax-free and go to your heirs tax-free. But it's a real tax. If this is something that I won't do without speaking to a client's accountant. Like, it can affect so many things. And it's a great strategy. You just have to do it in the right years. Maybe you do it over a couple years, but you can have a really big tax hit. And if you're in retirement, you got to be careful if it's affecting your Medicare premiums. Is it affecting the taxation of your Social Security? There's so many like things that weave in and out of that, but it can be really great planning. And if you can do it smartly, you can convert these pre-tax dollars to dollars that eventually come out tax-free.
Yeah, it's a common strategy that we see people who are at that higher level of income and can't contribute to a Roth IRA. They do this conversion workaround. Yep, exactly.
Yeah, so the back door is a little different. The back door, you'll do an IRA contribution today, basically, and convert by the end of the year or tomorrow, depending on how quickly you guys do it. So for those people who are limited by their income, they do a non-deductible IRA contribution. They convert to a Roth right away. So there's almost no tax issue. And now they can hit the growth of the Roth. It's a simple, excellent strategy. You're limited to $7,000 or $8,000 a year, depending on your income, your age. The big conversions, like those one-time things that you could do, are a little bit more of a lift, but they can be great strategies.
Yeah. And to your point, they just require a lot more planning with your financial team.
Yeah. Yeah.
Can you touch a little bit on diversification within your investments?
Yeah. It's super important, and it's almost harder to sell right now. I want to say sell in quotes, because US large cap has done so well for so many years. But the reason we diversify is to mitigate risk. And you never know which asset class is going to be the best asset class running. It does change. It does seem like it's only been large cap growth, but if you look back over time, even just 20 years, it's been different asset classes. It's been small. It's been emerging markets not even that long ago. I looked back at the chart to see what the top performing classes were. So it is really important to have all the different classes. And I don't know if this is interesting, but it was interesting to me. In so many 401ks, they have target date funds as options. And so many people just choose those. So it's the date you retire, the fund is built around that. And they all have international, they all have emerging markets in them. They all have small and mid and large. And I haven't seen one that doesn't have that, because they want people to, if they're not going to have their hands on it and pick their individual stuff, they want it to be really diversified. So in some years, yes, it will hold your returns down. If you were diversified last year, you did not do as well if you were all in large cap stocks, US large cap stocks, but we're trying to mitigate risk over time.
Yeah, absolutely. So another really hot topic when we talk about the future and investments and savings is Social Security, and specifically when someone should take it. Now, this has been a whole separate office hours in itself. But is it, generally speaking, is it better to maximize and hold off? Do we take it as soon as we can, with the idea that it might not be there? What are your thoughts overall on that?
So I can't say there's a general answer. And I've been speaking to somebody recently who does it very differently than my general rule, but just to lay out the parameters super quick, you can take it between 62 and 70, basically. It's reduced at 62. It's the maximum at 70. If you keep working, it could go up, but that's the maximum. That's the range. There a lot of planning with couples, because you can get a higher benefit based on your spouse's benefit level. So, sometimes one spouse, we see this a lot, where the older spouse with the higher benefit in like a traditional marriage, maybe the man's older and has a higher benefit, will wait till 70, because often that person passes away first, unfortunately, just statistically. And so therefore the remaining spouse can step into a higher benefit, because that's the spouse that died, waited longer to get it, has a higher benefit. So the younger spouse that's still there can step into this higher benefit. On the complete flip side, if you really don't need, the Social Security, you have enough income. Some clients say, I don't need it. I'm just going to wait till 70, whatever. But some clients say, well, I'm going to take it early. I'd rather have the money now. It doesn't make a big difference to me from a cash flow standpoint. I'd rather have it for the extra 5 or 6 years, depending how early they take it. And you can do some, time value of money calculations and figure out if it makes sense to have, if you take it at 62 instead of 70, the 8 years of income, what's the math on those numbers? And does it make more sense to take it now? The only other thing I want to throw out is that I see there's a columnist I see all the time that always says, wait, 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 wait. But if you're withdrawing from a retirement account so you can wait, that's you got to weigh that decision. You were withdrawing from a retirement account that's making 8, 9, 10%. So you can, like, you have to weigh where you're getting your money from while you're waiting, and to decide what to do with it. The
Yeah.
8% guaranteed growth from 67 to 70, from full retirement age to 70, is pretty meaningful.
And again, there is no scenario that's the same for anybody.
No.
If you've been divorced, if you have a current spouse, there's a whole different formula for all the different scenarios. And again, it's one of those things where I really think engaging with a professional is the way to go to make the right decision. At least understand what your options are and how it plays into your whole plan.
Yeah, I mean, we'll run the numbers and our cash flow all different ways, taking it this time, taking it that time. And then, like, what if there's a down market, right? What if there's a down market in the year that you were going to wait, right? You were going to draw from your investments because you're going to wait on Social Security, and then there's a 20% down market. Well, that may change things. So it's good to have the whole plan working together, all the parts.
And Social Security is similar, and this was a pre-submitted question that we got about pensions. And how do you work pensions and what those future benefits might be into your overall plan as an individual?
Yeah. I mean, when we do a cash flow, I love to see a pension. We don't see them too much, but it's that I talk about the foundational, like if you can get your core expenses covered by fixed income, I'm putting in quotes because pensions may go up and Social Security does increase, but if you can get your mortgage or whatever those base expenses are covered by a pension and Social Security, you're in a great place. Because in really good years, you have more money you can take from your investments. And in really bad years, you can pull back a little bit because you have this foundational, money. It doesn't happen as much anymore, but pensions are a great tool to be able to and they change how we invest. Like, client with a pension may invest slightly more aggressively than a client without it because they know they have this money coming in. So it's very integral.
All part of the plan. We did have a question come in through the chat, and if you could talk just a little bit about the use of life insurance as an investment vehicle.
Yeah. So life insurance, I'm talking about this a lot lately with a client, is can be like a term where you buy it for 20 years, and when you're at the end of 20 years, you're done and your kids are older and you feel like you don't need it. But there is absolutely lots of insurance vehicles out there that allow you to accumulate cash inside the policy. And a lot of people don't understand this, but you can build policies so they focus on cash accumulation instead of death benefit. It will always have a death benefit. It has to legally, but that this cash builds up more than the death benefit does. And it's helpful to use a sophisticated life insurance person when you do this, because not everybody knows how to do it or really gets into the weeds on that. And if you're going to use it for income, that's what the cash can be for. And also the cash inside the insurance companies, inside the insurance product, can be invested, in an index. It can be invested in actually underlying mutual funds. If it's a whole life policy, it's the dividends guaranteed by the insurance company itself. So it's not in the market, if you will, it's interest rates. So they all have different ways. And when you compare insurance policies, it's really important to understand what's underneath it. Like, is this an interest payment? Is this in the market? Is there a cap? It's a very complex marketplace, but I understand and agree that insurance can be a part of your investment plan. And the last thing I'll just say on that is I have clients that are very comfortable doing that insurance. And I have a client that said to me once, she's like, I've got all my money in the market. I want a guarantee on this insurance policy. I want to put it in the drawer and never look at it again. No, my kids are going to get $1 million. She's a very sophisticated investment person, but she just didn't want her investments like there. She felt like they were over here, but everybody's different. You just have to understand it. That's the key, right?
So I want to wrap up this section. What is your takeaway on this particular section?
So, the one thing I was going to point out is on the Social Security is that everybody should go to ssa.gov, Social Security Administration, it stands for, and get their benefits, because you can't make a decision without the numbers. So a lot of people haven't looked. We don't know, most people don't get the papers in the mail anymore. So go to ssa.gov and get your Social Security benefits so you can see.
Awesome. We're going to skip the next poll only because we're getting some good questions in and I want to keep giving content to the group. So The next section we're going to do is on estate planning. And this is going to cover a little bit of insurance. It's going to cover a little bit of, some planning and what happens during, the probate time of wills and all of that, and beneficiaries. So Lisa, if you could just kick us off, going back to some of the general types of insurance that individuals can get and when they're most appropriate to obtain them.
Right. I mean, so the basic, I think when most people think of insurance, they think of term, they have their first child, buy a policy. So if something happens to you, the other spouse can stay in the house, can afford to take care of the child, whatever it may be. So we like to see young parents have insurance on both of them, not just the working spouse, because if you only have it on the working spouse and the one that's taking care of the kids passes away, you still have a void to fill. So, and those, maybe will be 20, 30-year terms. So they finish when maybe the kids are out of college. Those are very straightforward. They're reasonable. A little note on those is some term policies are convertible. So meaning you can convert them to a permanent policy at one point. It's not much money usually to add a conversion feature to term policies. I do this a lot with my younger clients. Like, who knows? The point of conversion is you don't have to prove insurability in order to convert this to a permanent policy. And nobody knows what life's going to hand us. So having that feature in there can be very useful. When I usually give clients the two options, they often opt to have that feature. You have to be careful. It's only available for a certain period of time. And once you convert it, policy is going to be much more expensive. But I really like people to be aware of that. A second other type of insurance is permanent. So it can be whole, variable, indexed, universal, there's a whole bunch of them. But the point of those is there's some growth inside the policies. There's the insurance piece, and there's the part that's growing to potentially grow cash value or to increase the death benefit over time. So, these are all the whole thing about tools in your toolbox. They're all tools. Just get the right tool for what you're trying to achieve. And that's really important, to ask a lot of questions so you're getting what you want out of it, because there's so many policies out there. Then, of course, there's long-term care.
Yes, I find this so important and so underutilized, and even not a lot of knowledge about it with individuals who haven't been affected by, someone in their family who needs it. So I'd love for you to unpack some things around long-term care.
So I like to put the long-term care policies in three buckets. There's your traditional long-term care where you buy it just like your car insurance. Every year you pay for it as long as you live, and it generally goes up. Maybe not every year, but consistently goes up over time. I have had clients call me and go, oh my God, I was paying $2,000 a year 20 years ago. Now I'm paying 5, 6, 7, whatever the number is. And it goes up as you get older, which also sometimes really gets hard for people. They're retired and this policy keeps going up, but they pay benefits out. They're definitely viable policies. The second ones are generally the ones that sit on top of life insurance policies. So a long-term care rider on top of a permanent life insurance policy. So you buy a permanent policy that you want to last your whole lifetime. You're paying premiums. You pay a little extra to put this rider on top. If, for example, if the policy had $1 million death benefit, you can access that death benefit, or sometimes, and you can set it up, access 50% of it, 75% of it, if you qualify for long-term care while you're alive. If you use that, your death benefit goes down when you die. There's less, death benefit. You have to qualify to have this on the plan. The third kind are the kinds, I don't want to say my favorite, but I really like these. Again, for the right reason. They're hybrid policies. They also sit on a life insurance chassis, but differently. And I'm going to use a number example because it's easier. $10,000 a year, I see the most frequently put into these policies for 10 years. If you're young enough and you buy it, it might be $7,500 a year for 10 years. But say you put in 10, that's $100,000. When you need long-term care, which the average age you need long-term care is in your early 80s, you may have a bucket of benefits worth $400,000, $500,000, $600,000, depending how old you were when you bought it. But all the growth, all the leverage is on this long-term care bucket that's sitting over here. If you die and you don't use a policy, your heirs get back the $100,000 that you put in, plus a small rate of return. So there's no $1 million death benefit. There's no highly leveraged death benefit. All the money goes towards the long-term care bucket. You have to qualify for these policies. So I say to people, the best time to buy them is in your 50s. The prices are better. It's easier to qualify, and you can get them done. You can get them paid for before you retire. So they're really good policies. My thing with the insurance is it's so interesting because some people can self-insure, but still choose to buy these because they have seen what happens when a parent needs care. And what if there's 3 siblings, right? There's only one parent left. There's 3 siblings. Who's going to pay for it? Well, sibling A makes a lot more money than sibling B, but sibling B lives nearby and does all the work, all the driving around. So it takes some of the pressure off the family, knowing that there's a bucket of funds that's going to help pay for mom or dad. It doesn't alleviate all of it, but it really does transfer some of this burden to an insurance company. And I find the families that have it are generally pretty happy about it.
And it gives you options. It gives you options you may not have had without this policy. And, in-home care with not even talking about skilled nursing. I'm talking companionship, maybe some light cooking, that type of thing.
Yeah.
You're looking in New Jersey around $34, $35 an hour for that type of service. And there's minimums each day and each week. If you're talking full-blown private room in a memory care facility, you're looking at, in New Jersey, again, about $11,000 a month starting.
Yeah.
So, and that's, with that base level of care and all of that. So it is sometimes I have very strong feelings about this, but sometimes people just don't know because they've not gone through the experience. And, you have to really have all that information, I think, to make the right choices.
Yeah.
So I'll come off my soapbox about long-term care.
It's true. I find the clients that are more apt to buy it are the ones who had parents that either did or didn't have care, but needed it. I mean, did or didn't have insurance, but needed it. And these policies, I don't know, it was maybe 10 years ago. There's a lot of companies that really were in the news. Some of the companies blew up. Things didn't go well. It's all been, I want to say all, but it's been very straightened out. The poor, weak companies are out of the marketplace. The good companies are left. They're paying their benefits. There's very clear rules on when you get paid. So I think the marketplace is better than it was a decade ago.
Yeah. And there's, like you said, there's just more policies, more flexibility in them.
Yeah. Yeah.
One of the areas you touched on when we were talking about retirement plans was beneficiaries and how things pass to heirs, post death. Can we talk a little bit about how those assets pass?
Yeah, this is such a point of confusion for people. Everything that has a designated beneficiary on it, which is all the retirement accounts, 401ks, 403bs, Roths, IRAs, 457s, all of them have designated beneficiaries. I cannot open any of these accounts without putting a beneficiary in the application. Like the custodian won't accept it. That's who those monies go to. It doesn't matter if you put this is the biggest one you see. Ex-spouse is on the 401k. You've updated your will. You got divorced. You updated your will and you put your kids or whomever. You die, it goes to your ex-spouse. No judge is going to say, oh, she forgot or he forgot. It's going to the name that's on that document. That document overrides the will. Same with life insurance, direct to those beneficiaries. So, you got 3 kids and you have 2 on here and you got 3 in the will and you think you took care of it. You did not. So I can't say this enough because people are so surprised. All those documents should be up to date. And a tip I really love, if you have parents and you have one parent left, one has, passed away, make sure that you have updated the contingent beneficiaries on that. So we have mom and dad, maybe dad passed away and mom had dad, but she doesn't remember to update it. You got to make sure you have if they want it to go to the kids, that secondary beneficiary on that, because you just don't know as you're in your 80s, life is finite.
Yeah. And I mean, that goes back to your point of you've got to know what assets you have so that when life changes happen, you can go back and make the necessary changes you need to the respective accounts. And I think that's, again, why it's important. Review these documents annually with your financial professionals, because, that checklist will happen and we'll go through it and you may not have thought to do it, but it'll save you a lot of grief in the long term.
I wish all the statements list who the beneficiary was, because it's often not there. Some companies do, some don't. So you ask a client, they're like, I don't know, and they have to call or they have to log on or whatever, and they can't find their password, but you got to do it. You find out where they go. So all that stuff will be taken care of through the will, and then through the direct beneficiaries. And the will is for the stuff that doesn't have a designated, beneficiary on it.
And talking about wills, believe it or not, I have some clients, or we've come across clients over the years when they've joined our firm, that don't have wills.
Yeah.
And so a common question that I get is what happens, and we can talk specifically about New Jersey because that's the state that we're in. What happens when you die without a will? Do you have any insights to share here?
Yeah. Well, first thing, if they have young children and they don't have a will, they have to have a will. Because they have to put the guardianship for the kids in there.
Sure.
And I finally got a client recently who had been putting this off to act the other day. I said, you are making a decision by not making it, like they hadn't done it because they couldn't decide who to put for the guardian. I've seen this happen. So they don't make a decision. I said, by not making a decision, you've made a decision for the courts to decide, because that's what's going to happen. and that got her moving. But, so things like anything that's not in joint name also, I forgot about that. Anything in joint name passes directly to the other holder at death. So if you have a house in joint name, it'll pass to the surviving joint person, same with a bank account. But things that don't have beneficiaries on them are going to go through the will. Now, just a little note, New Jersey is not known for having bad probate. That was a double negative. New Jersey's probate is not difficult. I've had estate planning attorneys tell me that if everything is in IRA accounts or joint bank accounts and a joint home, that you don't need much in New Jersey to avoid probate. You might still want to have a will for your wishes and your jewelry and stuff like that, but you don't need necessarily a revocable trust in New Jersey, because probate is not terribly painful here. In New York and Florida, which tends to be, we know a lot of people in those states, it's the opposite. You want a revocable trust for everything because you want to avoid probate to help it go more quickly and save dollars on that. But everyone should have something in a will, at least to decide how you want to be cremated or buried. What do you want to do with your jewelry? Just some direction. It's the trust, those revocable trusts, that are not necessarily necessary in New Jersey if you don't have many assets.
And, it's important to note too, you mentioned New York and Florida, and oftentimes we find our clients have multiple homes and, homes in multiple states.
Yes.
And you will have to go through probate in every state that you own property in. So that's an important, caveat to add on to this conversation.
Yeah. We have a lot of clients that do the revocable trust in Florida for those homes, so they don't have to deal with the probate of Florida, which is tricky. And it's a pain if you live up here.
Yeah. You did mention trust, so I don't know if there's anything else overall. Again, we're doing kind of high level, just,
I mean, the only thing I'll say that, so revocable trusts do nothing from an estate tax standpoint. It's just a titling mechanism. And then it allows you to indicate where that asset goes at death. So it's like a wrapper, if you will. Mm-hmm. You don't need to do them just to have one again in New Jersey, but you may have reasons to do that. All the other trusts usually have estate planning reasons to do them. Grantor remainder annuity trusts, charitable trusts, spousal trusts, slats. What's the other one I was thinking of? So those are usually done to get some assets out of your estate so you don't pay estate taxes on them. But I always remind people that you don't pay estate taxes right now until you have $26 million as a couple and 13 as an individual. And I believe that is less than 1% of the population.
And they're probably not on this call.
I had that number before. I think there was 1,000 taxable estate returns last year filed. So it's a low number. So you don't have to rush to do estate planning if you don't have $13 million. I will point out, though, in New Jersey, there is still an inheritance tax in New Jersey, which people never realize. Not many
until it's too late.
Before it's too late. And sometimes it is what it is. But if your money goes to your spouse or your direct heirs, your kids or your grandkids, there's no inheritance tax in New Jersey. But if it goes to siblings, cousins, nieces, and nephews, which is very common, there is a tax, and it ranges anywhere from, I think it's 11, that's why I put my glasses on, 11 to 16%, depending on which class you are. So if your aunt gives you 50 grand, you're going to have to pay maybe 12, 13% on that. So just, you still get the rest of the money, but there is a tax.
Yeah. And that's important too, when you talk about planning for, your own will. And if you want to leave it to, a non-class A beneficiary, which is how they categorize it in New Jersey, understand that tax is going to, eat into whatever your desired gift to that individual is, or, endowment, if you will, to that individual.
Yep, absolutely.
So what is your takeaway on this section all about retirement and estate planning?
I would say the biggest one is check those beneficiaries on all your retirement accounts. You might have some old IRA floating around somewhere. You don't even remember where it is. Find those, by the way. Find everything that's out there. See who the beneficiaries are, and check your life insurance, because that's really something you tend to put in the drawer and forget all about. Check what, the beneficiaries. And if it's a term policy that's ending, check to see if there's a way to convert it if you want to keep insurance.
Great, definitely. Great. So we did get a question through the chat, and it's about 529 plans. So it's specifically how much should be targeted per child into 529 plans. What are your overall thoughts on that?
Yeah. I mean, if you're trying, it just varies so much, but right. I mean, college can be anywhere from 20 grand a year to 80, 90 grand a year. And how many kids you have. I think it's what you can afford to put away. I have this chart that that our software uses, and I think sometimes when people are planning, let's just say 200,000 per kid, 50 grand a year for, 4 years, and just, you can use that number, and you have 2 kids, it's $400,000, and it starts to become like, oh my God, how am I going to plan for this number? So I would do what you can and start early. That is the key. I mean, the magic of compounding is just the key. Start early. Even if you can only do $100 a kid, do it. And then next year, try to get it to 200, 300, 400. So by the time they're 10, maybe you're doing 500 a kid. But this chart that I have, I really find helpful because it shows a bar chart for the cost of each year and how much of that you're taking care of. And so sometimes it's such a daunting number, 400 grand, 600 grand, whatever it is, that you just put your head in the sand. But when you see the chart, you can say, oh, look, I've got covered now a year and a half. Okay, so a year and a half of the chart is now turned to green. Now only this is red. And it's good. If anything you can save is less you have to take out in loans later or deal with later. So if you can get 100 grand saved, so that's a quarter of 400,000. That's good. So don't let the large numbers, take over. But I do think I can't give you a number because I don't know where you think your kid's going to go. Like I have people like, my kids are going to go to Duke, all of them. So you better start saving. Or my kids go to Rutgers. So it just, but start young and get in, I would start easily with, a couple hundred for each kid right away, and then see how much you got to look at your own cash flow. Do you have the money to do it? Do it.
Yeah. Yeah. It's tough. It's tough to give advice globally, right? Because everybody's situation is different.
And there's an interesting thing that I don't know if they changed it or if it was something with the 529s. If your child gets a scholarship, you can get that money out of the 529 without penalty. Still have to pay tax, but no penalty on that. So, if your kid's brilliant and gets a scholarship, you'll be able to get some money back out. And they've opened up, you can go from sibling to sibling. You can get some of it out and put it into a Roth. Those rules are very limited. They looked like great when you saw the headline, 529s can go into Roths, but there's a lot of caveats to it. So read the rules. I won't go into them now. But you can get some money out if you put it in, without penalty.
Yeah. I mean, listen, to your point, they changed rules on it. Now it applies to not just college, it applies to, private high schools, private elementary schools, and different things like that. Yep.
Yep.
So Lisa, as we approach the top of the hour, why, in your opinion, is financial literacy important, not just for the business owner or the adult, but why is it also important for children? And when should we start having the conversation with children?
Yeah. I mean, I think we should start having the conversation early. I did this thing when my kids were young, like instead of saying if your child wanted something, who knows what it was, a Lego set, instead of saying you don't need that or we can't afford that or whatever it is, say it's, I'd like to tip the conversation a little bit. I used to hear somebody say this to the kids all the time. Oh, we can't afford that. I'm like, no, that's not, they don't understand that. We don't need it. It's not worth the money. It's just like flipping your head a little bit on the conversation and not just always throwing out the money reason, but it's something we don't need. We have 4 at home. We don't need this one. Or that Lego set, I have to work a week. Hopefully it's not that, but I have to work a week to pay for that Lego set. I have to work for a day to pay for that Lego set. It starts to give them a little bit of context. But nothing works better than a kid getting a job. There's just not, I mean, you can't do that when they're 4. I understand that. But nothing works better. I will remember when my youngest got his first job, and he said to me, I have to work 2 days to pay for that. Like he wanted something. And it was like a light bulb went off. And so it made me think, putting things in context, like, you know what, you guys, we're doing this vacation. We're not doing it this year. It's really expensive because it takes me a month of work to pay for this vacation. Like, okay, something people can kind of conceptualize. Or we're really lucky. I can do it this year because I had a great year. And now I don't know. It's just starting to let it not be taboo to mention money. You don't have to tell them how much you make. I think parents are always afraid I have to tell them how much I make. You have to tell them that, but just let them context of money come up here and there. We're not going to do that because it's a waste of money. It's not too expensive or too cheap. It's just a silly place to put our dollars. I don't want to put our money in that direction.
Yeah. And your point is well taken, because I think everybody has their own head trash about money, and however you grew up, whether you could talk about it or you couldn't talk about it, or it was shameful, or, whatever the history is, right? It's a lot for us as individuals to unpack. And, we're bestowing some of that onto our children if, we don't approach it from an education standpoint. And I
Right.
think that's really, I mean, that's my takeaway, and I'll ask you yours, but my takeaway is really, come to the table with your children from an education standpoint so that they can learn and develop their own head trash, not just absorb yours.
Very well said. Yes, you said it better than I did. It's absolutely, it is. It's your money that you grew up with, throwing it out on them. Like, try to just, it comes back to clarity, transparency. Again, it doesn't have to be tell them what you make, but
Right.
it's a good conversation. Is I don't want to spend money on this because I would rather spend money on us going on a trip than buying this plastic toy or whatever.
Right. Right.
Yeah.
Lisa, as we wrap up, any final thoughts for the audience?
I mean, as a financial planner, I always have to tout plans. I mean, I find personally when I'm getting stressed about a money thing, if I go and write it down and start working through the numbers and figuring it out. And I did this with all my kids with college, like constantly figuring out how we're going to pay for it, combination of, savings and loans or whatever. But when I figure it out and face it head on, it's less scary. So I think, don't bury your head in the sand, face it and get some clarity. And I think most people feel better when they have clarity, not worse.
Yeah, I agree with that. I agree with that. Thank you so much for joining us today, Lisa. It's really such an important topic. We did a lot of high level coverage on things. We can certainly do deep dives, and I know that you can as well, into each of these different categories. But it's certainly a great topic to have top of mind as we finish the first month of 2025. And you gave some great tips and takeaways to bring clarity to your personal finances. So thank you so much for being with us this morning.
Thank you for having me. And thanks everybody for joining on a Friday morning.
Yes. And thank you to the audience again for being here. We have a great lineup of topics for 2025, but please let us know if there are specific topics that you would like us to present on, because we always want this to be as meaningful and as important to you as it possibly can be. So please message us if you have any topics. We'll find an expert to bring on. So thank you, everybody. Again, have a great rest of the day. Have a wonderful weekend, and we will see you in the upcoming months. Take care.